All right, so like we talked about, you're actually going to apply your applied and actual overhead to the same manufacturing overhead account for each cost pool. Okay, like I said in an earlier video, this rarely ever washes out to be exact. Okay, what's going to happen is you're either going to have too much or too little. Okay, so if your manufacturing overhead account ends the period with a debit balance, what this means is that the actual overhead was greater than what we applied. Okay, this means that the overhead in the cost pool was underapplied. This means the cost of manufacturing inside of the work in process inventory is going to be understated. Okay, if you have the opposite problem, if your manufacturing overhead ends up with a credit balance, right, then the applied overhead was greater than the actual overhead. What this means is that the overhead in the cost pool was over applied. So now you're going to be overstating those costs of manufacturing inside of your work in process account. Okay, so that's what those two things mean. But if you remember, and I said it several times at the beginning of these lectures, you are going to have to close this manufacturing overhead account because it is a temporary account. So it doesn't matter where it doesn't matter whether you are underapplied or overapplied. At the end of the period, you're going to have to make an adjustment. Okay. So the final step is this is that we're going to record finished goods. We're going to take all of these costs of goods manufactured. So those all those things that we moved from indirect materials and all that good stuff. We come up with your work in process inventory ending balance, and we move that from the work in process inventory to the finished goods inventory. And we do that the same way here. Okay. Recall, though, that the costs include direct labor, material, and all the applied manufacturing overhead. So the applied manufacturing overhead being all those indirect material and labor. Okay, so let's assume that they completed the production of 6,000 iPhones. It cost them $842,000. That was their cost of goods manufactured. So that included all their direct and indirect material and labor. We would increase the finished goods inventory by $842,000, and we're going to decrease the work in process inventory by the same amount. We are basically moving that value from work in process to finished goods. Now we are saying we are done with the process. We are done with building these iPhones. Now they're ready to sell. Since they're ready to sell, we have to move them to finished goods. Okay. A lot of companies, most companies will create this cost of goods manufactured report. Okay. It is prepared to show the changes in direct materials inventory and the work in process inventory during the conversion, during the accounting period, right? So this is showing whoever's interested, typically somebody internally, how things moved from the direct materials, the raw materials inventory to work in process inventory, and then finally end up in your finished goods, okay? This is an important one. I would take note of this. I would write this down. I would guess you're probably going to have a question on your exam asking you to create a cost of goods manufactured report. Okay, so you start with your beginning balance of direct materials. Then you add in any direct materials purchased during the period, right? Any direct materials that you're going to requisition, whatever the case is. Okay, that gives you your direct materials available for use. Finally, you reduce that by your ending balance of direct materials, okay? So whatever your ending balance in direct materials is, if you reduce your beginning balance by that, that tells you how many direct materials did I issue into production? How many were requisitioned into production, meaning into your work in process account. Then you can start with your beginning balance of your WIP inventory. You can add any of these direct materials that were issued into production. Then that is going to tell you the direct materials that you used in production, and then your manufacturing overhead applied to production. Okay, that gives you your total work in process inventory account. Okay, so all of those added together is your work in process inventory account. Finally, you're going to reduce that by the ending balance of your WIP account, and that gives you the total cost of goods manufactured. If you go back and look at an early slide, I have them color-coded red, green. It will tell you what's an addition, what's a deduction, okay? And it's from your direct materials to your work in process to your finished goods. That will help you build out this report. It will show you how this works, okay? So there are internal evaluations that we use for the conversion process, okay? We're going to be gathering information. The company is going to gather information about this process throughout the entire period. They're going to make some calculations, and that's going to help them determine the efficiency and effectiveness of this conversion process. Anybody that is a management major, you are going to hear those two words constantly and forever: efficiency and effectiveness. Okay, how efficient and effective was the conversion process? One of the best ways that we can evaluate the conversion process is to calculate a variance. Okay. I did a lot with variances when I worked at Mercy. Part of my job was as a variance analysis for financial statements, a variance analysis for any of our reserve models, that kind of stuff. So I can tell you exactly how important variance analysis is for a company internally. They do it constantly. And in fact, all the financial statements that we had at Mercy had a variance analysis built into them. So we would have one column for budgeted, one column for actual, and then you would have the variance between the two so that we could see were we favorable or unfavorable. We'll get to all that here shortly, okay? So one thing to note, variance. A variance is the difference between your standard and the actual amount of the input, right? So the standard is basically what you've budgeted, okay? So it's either going to be the amount that is required to make a unit. Let's say it takes 3 processors to make a phone. I don't know. I'm not an IT guy. You know, let's say it takes 3 processors to make a phone. Well, that is your standard. Okay. If you use 4 processors to make a phone, if you have to for whatever reason, then you've exceeded the standard, right? Your variance would be a +1. Okay. Or it could be the budgeted cost per item. So let's say you've been using a vendor for 5 years and the cost on a particular per unit cost for you is $5 from that vendor. That's what you're going to budget. You are going to assume that it's going to continue to cost you $5. Well, you may be able to get it from that vendor at $4.50, or you may have to pay $5.25. There's a variance there, right? It's the difference between the standard and what you actually have to pay or actually have to use, okay? So just for example, let's say the unit requires 3 pounds of materials, should cost $5 per pound. 3 pounds is the standard amount, $5 is the standard price. Okay, anything different than that is going to be a variance. Now, the most common variances that we're going to analyze in this class are going to be price and usage variances for labor and price, usage, and inventory variance for materials. So you're going to have to know how to do 5 different types of variance calculation. And these I would recommend studying because they can get a little tricky if you're not paying attention. Okay. So in the next video, we'll start walking through some variance illustration and talk about some variance examples. So if you've got questions, please let me know. I'm always happy to hear from you.